1980s, I was giving a lot of speeches as the chief economist in the Harris Bank, and I was giving speeches in this area too. And at that time, we had a major recession. And my forecast was a lot better. I said, because of the economic policies that have been put into place, we are likely to have a decline in the very high inflation. We're going to see a decline in interest rates. We're going to see a strong recovery and a bull market in stocks. And I'm just curious, in the audience, is there anyone here who happened to be able to hear me and remembers that far back in the early 1980s? Show of hands, anyone? Oh, great. Yeah, we had about 4, 5, 6 people because I've been doing this for so long a time. More recently, I was successfully able to forecast the historically low interest rates that we've had. In March of 1980, before the worst part of the financial crisis, Burl Sprinkle, my mentor, and I wrote a paper that the Fed had already become so restrictive it was going to be difficult to avoid a downturn in the economy. And I advised people to get out of the stock market prior to the worst part of the decline. I also was quickly to shift back and advise people to get back into the stock market in the early part of this recovery. And I've been pretty much a bull on the stock market ever since. So the question remains, if you can't know the future, how is it that you can expect to get some of these forecasts about, especially the broad trends in the economy, correct? And the answer to that, I believe, can be found in the most famous economics book ever written by the most famous economist who ever lived. And no, it's not me or my book. It's this book. It's The Wealth of Nations, written by Adam Smith 250 years ago. You can tell my copy is a little worn. If I dropped it, all the pages would fall out of it, and all my notes would fall out of it. Well, what was so special about this book, The Wealth of Nations, that makes it the most famous book in economics? What Adam Smith did is he said that if we gave people a maximum amount of economic freedom and control over their lives, that they would innovate, they would become productive, and you would have the greatest amount of goods and services created for the greatest number of people. The principles he laid out of giving people economic freedom were make sure that government spending grows slower than spending in the rest of the economy, make sure people's taxes are low so they can enjoy the maximum freedom to enjoy their earnings, make sure the government doesn't interfere in markets, free markets. They should respond to supply and demand. Make sure the government doesn't regulate the economy. Make sure people are secure, both in their persons and in their property. I call all these principles classical economic principles. And I call them classical not so much because they're old, which they are, but I call them classical because they are fundamental. They are based on human nature. They are based on how we humans respond to economic pressures. And we respond, for the most part, to economic pressures pretty much in the same way, whoever we are and wherever we are.